Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Sidus Space.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you need emergency cash and want to look at a short-term installment loan option, you can check out MaxLend Loans through my link below. Eligible customers may qualify for loan options up to $3,750, and funding may be available quickly if approved. But please be careful. Always read the full loan agreement, APR, fees, repayment schedule, and total cost before signing anything.
So diving right into things today, we are looking at a company that is right in the middle of a massive identity shift.
Yeah, a complete structural transition.
Exactly. They're attempting to pivot away from being just a legacy hardware integrator.
Yeah.
Basically building metal boxes for other people.
Right.
And they're trying to become a high-margin data provider instead.
Mm-hmm.
But anytime a company tries to rebuild its engine while the plane is literally still in the air.
Or, while the satellite is in orbit.
Right, exactly. It brings a ton of volatility. And this stock has seen some absolutely blistering price action recently.
It really has.
So today, we need to unpack all of this. We've got the financials, the charts, and some highly critical short seller research, too.
Oh, yeah, we definitely need to get into that.
All right, let's move into the wealth building context.
So, for any long-term investor looking at this sector, you have to understand that the narrative has completely changed.
How so?
Well, it's not just about launching rockets anymore. The whole industry is moving toward this space and defense as a service model.
Okay.
And Sidus Space is building their own proprietary fleet of satellites. They call it LizzieSat.
Right, the LizzieSat fleet.
Yeah. And the core thesis here is transitioning from a transactional business to a recurring revenue business.
Yeah.
Because the old way was you build a satellite, you sell it to a client, and you get paid once.
Which is, it's a tough, low-margin grind. You're basically a mechanic in that scenario.
Exactly. But the new model, you
Yeah.
keep the satellite, you own it, and instead of selling the hardware, you sell the continuous stream of data it generates.
Ah, got it.
You sell subscriptions to that data feed, over and over again to multiple clients at the same time. That is how you get exponential margin growth.
But to get there, you're essentially building a massive, incredibly expensive toll road in space.
That's a good way to look at it.
Right. The engineering is unprecedented, and you have to finish the entire road before a single car pays a toll.
Yeah, it's a huge front-loaded capital risk.
You have to have a lot of patience as an investor to sit through that construction phase.
Yeah.
Which brings up their AI tech. They're trying to build these floating data centers, right?
Right. They call it the Orlaith AI ecosystem. And it is arguably their biggest competitive moat. It's edge computing in orbit.
Explain that a bit for us. Why does putting AI on the satellite matter so much?
So historically, satellites were just, kind of dumb. They would take a massive high-res photo of the Earth and beam gigabytes of raw data down to a ground station, so computers down here could analyze it.
Which uses a ton of bandwidth.
A massive amount. And bandwidth in space is really slow and very expensive. What Sidus is doing is moving the brain up into space.
Ooh, okay.
Yeah, the satellite does the processing up there. So if the Defense Department is looking for a specific ship in the ocean, the AI scans the photos in orbit, finds the ship, and just sends down a tiny text file with the coordinates.
Wow, so you're just beaming down the actual intelligence, not the raw data.
Exactly. It's near real time. And once a government agency integrates that kind of speed into their systems, the switching costs are incredibly high.
Now let's look at the fundamentals. Because if we go back to that toll road analogy, laying down this digital asphalt in low Earth orbit is incredibly expensive.
It is.
And frankly, looking at the numbers right now, they are pretty ugly.
Yeah, the top line numbers are definitely tough if you don't dig into the mechanics underneath.
Well, let's lay them out. Because for the full year 2025, revenue actually contracted. It dropped 28% down to $3.38 million.
Right.
And the profitability is deeply negative. We are talking about a $5.69 million gross loss, which comes out to a negative 168% gross margin.
Yeah, that is a jarring number.
And a $29.5 million net loss on top of that. Now, I know that includes a $4.5 million impairment charge on LizzieSat 1, but still, a negative 168% gross margin is usually where people just close the spreadsheet.
I totally get that. But this is where you really have to peel back the layers of the accounting, because those margins are heavily skewed by non-cash infrastructure investments.
Okay, break that down for us. Why does the margin look worse than the actual cash they're spending?
It all comes down to depreciation. The cost of revenue spiked 48%, right?
Right.
But that cost isn't just salaries or rocket fuel. A massive chunk of it is the non-cash depreciation from deploying LizzieSat 2 and LizzieSat 3.
Wait, so as soon as it launches, they have to write it down?
Exactly. Under standard accounting rules, once the satellite is operational, you have to start depreciating its value immediately on the books, even if the subscription revenue hasn't ramped up yet.
Oh, I see. So you absorb the full accounting hit up front.
Yeah. The bullish view is that once the data revenue does scale up, it will totally outpace that fixed depreciation cost, and you'll see aggressive margin expansion.
Okay, I hear you on the accounting. But a burn rate is still a burn rate. Even with depreciation, they're spending millions in actual cash to build these things. If you run out of cash before the tolls open, it's game over.
Which is exactly why they just made a massive financial pivot. They ended 2025 with $43.2 million in cash, which was getting tight. So in April 2026, they closed a $58.5 million registered direct offering.
Right. They priced those new shares at $4.35 each.
Yep.
But let's be totally clear here. To get that $58.5 million, they had to create and sell 13.45 million brand new shares. I mean, that is extreme dilution. You're slicing the exact same company into millions of extra pieces.
It is highly dilutive, yes, but honestly, it was a survival move. As an investor, you have a choice. Do you want a bigger piece of a company that goes bankrupt because they can't launch their next satellite?
Fair point.
Or do you accept a smaller piece of a company that now has a totally fortified balance sheet? That $58.5 million gives them the runway to build LizzieSat 4 and 5 without taking on crazy high-interest debt.
Okay, so they have a war chest.
Yeah.
But if I'm looking at this, I want to know when these investments actually start generating returns.
Right.
That brings us to the catalyst timeline. When does the cash start flowing in?
Well, the very first test of this new runway is the Q1 2026 earnings call coming up in late May or early June.
What are people looking for there?
Investors are going to be laser-focused on initial revenue from the Lone Star Data Holdings contract.
Oh, right, the Lone Star deal. That's a $120 million agreement. What are they actually doing for them?
So Lone Star is doing lunar data storage, literally putting data centers on the moon for disaster recovery.
Wow.
Yeah. And Sidus is manufacturing satellite infrastructure for them. So Q1 earnings will show if that $120 million agreement is actually hitting the income statement yet.
But there's another number floating around that we really need to dissect. We keep seeing headlines about a $151 billion total potential ceiling on the MDA Shield contract.
Ah, yes, the Shield contract.
Yeah, and $151 billion is the kind of number that makes retail investors lose their minds. But government contracts are rarely that simple.
Definitely not. The MDA is the Missile Defense Agency, and SHIELD is a program using low Earth orbit satellites to track advanced threats, like hypersonic missiles.
Okay.
And Sidus has prime positioning on this contract. But you are totally right to be cautious about that ceiling number.
Because it's an IDIQ, right? An indefinite delivery, indefinite quantity contract. It's not a guaranteed check.
Exactly. It's basically a hunting license. It means the government vetted Sidus and approved them to bid on task orders up to that ceiling amount across all the approved vendors. But there is zero guaranteed revenue until a specific task order is awarded.
Right. So using that ceiling to value the company today is dangerous. It just means they're at the table.
Right. So the real tangible milestone we need to watch is Q4 of 2026.
What happens then?
That's the scheduled launch for LizzieSat 4. It's critical because it carries their StarVault payload, which is their data storage solution, plus that Maristech AI payload we talked about. Every launch massively expands their capacity.
And there's also a big macro factor here. The recent U.S.-Iran ceasefire deal has created a huge risk-on environment for the defense and aerospace sector overall.
It really has.
Capital is just flowing back into defense-adjacent tech right now.
And that environment is accelerating M&A chatter. We are seeing major defense prime contractors snapping up small-cap space companies.
But wait, why would a massive contractor buy a company with a negative 168% gross margin?
Because they aren't buying current revenue, they're buying time. Sidus has 15 issued patents, the Orlaith AI ecosystem, and crucially, the facility clearances and approved vendor status. A big contractor can just buy Sidus to instantly bypass years of R&D.
That makes sense. Now let's pivot to the chart, because all of this potential is creating a fascinating story of supply and demand.
It's been a wild ride.
Before that $58.5 million capital raise, the stock went on an absolute tear. It ran from the low $2 range all the way up to a 52-week high of $5.59 in just a few weeks.
Yeah, a massive parabolic move, mostly anticipation of these contracts.
But then they priced that offering at $4.35. And the stock had this violent gap fill, pulling back down to the $4 to $4.70 range.
Right.
For anyone newer to charts, if the company just got $58 million richer, why did the stock price drop?
It goes back to that dilution. When you suddenly dump over 13 million new shares onto the open market, the supply drastically increases. So even if the company's overall value went up, the value of each individual share adjusts downward. The $4.35 price acted like an anchor.
Right. It's like hitting a speed bump at 100 miles an hour.
Yeah, exactly.
But the question is this technical digestion a sign of weakness or just healthy consolidation?
If you look at the momentum metrics, it actually looks like healthy consolidation. Buyers are aggressively defending that $4 support level.
Okay.
And even after the pullback, the stock is still trading almost 63% above its 20-day moving average and over 96% above its 50-day.
So the market is absorbing all those new shares without letting it collapse.
Right.
So what does market sentiment look like behind the scenes? When a chart is this volatile, you usually have two very different crowds fighting for control.
Well, the institutional appetite is super revealing here. To raise $58.5 million in a direct offering implies serious institutional buy-in right at that $4.35 level.
They aren't just gambling on the chart.
No, smart money doesn't write checks that big for a pre-profit company unless they've done deep due diligence on the contract pipeline. We also see the stock trading at a price-to-book ratio of around 7x.
Let's translate that. That essentially compares the market's valuation to the physical value of its assets, like the cash and the satellites, right?
Exactly. And the industry average is around 4.4x. So a 7x ratio means the market is actively paying a premium for Sidus. They're pricing in the future data as a service growth.
Now let's talk about the risks. Because we absolutely cannot ignore the bearish narrative here, and frankly, it gets genuinely concerning.
Yeah, it does.
The sentiment took a huge hit recently from a research report published by Fugazi Research. And they didn't just attack the tech, they went after the governance.
They flagged some very uncomfortable metrics. The most critical risk was extreme customer concentration combined with a related party conflict.
Right.
They pointed out that Craig Technologies accounted for 47% of the company's 2025 revenue.
Wait, almost half their top-line revenue came from one source?
Yes. And the real issue is that Craig Technologies is owned by the CEO of Sidus Space.
I mean, that is a glaring red flag. It looks like the revenue isn't coming from organic market demand, but is just being cycled through a related entity.
It's a tough look.
And to make it worse, the company formally admitted that its internal controls over financial reporting were, quote, not effective.
Yeah. When you combine related party revenue with ineffective internal controls, it legitimately spooks investors.
So how do you reconcile that? Institutions just handed them $58 million, but the governance structure looks incredibly shaky.
You have to look at how they responded. They didn't just put out a PR denial. They actively changed their inner circle. They went out and hired a new CFO, Adarsh Parekh, specifically to fix the reporting issues.
Okay, bringing in an external watchdog is good.
And they added heavy hitters to the board like Kella Wendling, who is a 30-year aerospace and defense executive with deep ties to the intelligence community. You don't attract a 30-year veteran to your board if the foundation is fundamentally fraudulent.
So the argument is that the ineffective controls were just growing pains from scaling too fast.
Right. The new CFO and board members are the moves a maturing company makes to clean up its act.
But I want to leave you with a critical question to ponder here. It all comes down to trust. Can you confidently invest in a turnaround story when almost half the current revenue comes from a related party? Is this new executive team proof of maturity, or is it just window dressing for the next funding round?
That is the exact risk you have to weigh.
So with everything on the table, what's the final verdict?
When we synthesize everything, the high risks of dilution and governance against the massive rewards of the new balance sheet and the AI data transition, the final assessment scores this as a 6 out of 10 on the bullish scale.
So leaning positive, but firmly high risk, high reward.
Absolutely. The target horizon is a speculative long-term hold, looking out 6 to 12 months. The thesis relies on holding through the Q4 LizzieSat 4 launch and seeing if that recurring data revenue actually replaces the related party revenue.
They've got the cash, the tech, and the orbital toll road is under construction.
Hmm.
But what happens if the space data market gets commoditized by SpaceX or Amazon before Sidus can fully operationalize? The race is definitely on.
It sure is.
Need emergency cash? MaxLend Loans offers short-term installment loan options up to $3,750 for eligible customers. Apply through the link below and carefully review the APR, fees, repayment terms, and total cost before accepting any offer.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.